Hi, welcome to Economy by Bhushan. Today we have chosen the topic Indian financial market with emphasis on bond market. As you know, in our Indian financial system, we have financial markets, we have financial instruments, we have financial institutions. So let us focus on financial markets. Financial markets are of two types. One is organized financial market and the second is unorganized financial markets. Among the unorganized we have money lenders, Gujarati or Multani or Shikharpuri shroffs, Marwadis, Kayas, Kshatriyas, etc. They are all form part of the unorganized sector. The second is organized financial market. The main organized financial market comprises of two segments. One is called money market and the second is called capital market. So what is money market? Money market is the place where there is sale or purchase of financial assets for a period less than a year. So we can say where financial instruments are purchased or you invest the money for a period less than a year, less than 364 days. That market is called money market. Now, what are the instruments in money market? Money market's instruments are treasury bills, commercial bills, certificate of deposits, commercial papers, bills of exchange, money market mutual funds, etc. These are the main financial instruments of money market. Now coming to capital market. What is capital market? Capital market is the place where there are sale or purchase of financial assets for a period greater than 1 year, or we can say more than 365 days. It may be 1 year, it may be 3 years, maybe 5 years, 7 years, 15 years, so on. And what are the instruments? Instruments are like bonds, debentures, shares, equity. What is important? So far as the financial market is concerned, this capital market is very important for an economy. Why? Because it is the market which provides funds for a long term basis, on long term basis. Because when you are going to invest, you require funds on long term basis. So that is why capital market is the important market for an economy. Now, who are the players? Who are the players of capital market? Capital markets are of two types. One is called primary market and the second is called secondary market. Primary market is that market where shares or you can say equity is floated. Fine. And the players in it are development banks, commercial banks, financial institutions like insurance companies, mutual funds, and individuals. And secondary market is the market where there is sale and purchase of the instruments of primary markets. So we can say in primary markets you can only purchase the instruments from the owner of the company. If you want to sell it, you have to sell it in the secondary market. Now, what are the instruments of capital market? As I said you, it is shares, equity, debentures, bonds. Some we call as pure instruments. Pure means they don't have their qualities, their conditions they don't share those things. For example, shares and bonds and debentures. Shares have different parameters, bonds have different parameters. Some are hybrid instruments. For example, we have combination of bond and equity. Sometimes bonds are issued with the condition that after a certain period these will be converted into, you have the option to convert it into equity. So we call this type of instruments we call hybrid instruments. Same way we have derivatives. Derivatives means whose happening depends on the performance of the contract underlying it. That means it depends on the happening of some other contract, on the principal contract. That's a derivative. Normally, these are used in hedging or foreign exchange. These hedging foreign exchange sale purchase transactions to hedge losses. The other instruments we have shares. Shares, again, we have preference shares. In preference shares, they are slightly different from normal equity. They are the shareholders of a company to the extent of their holding of shares. But preference shareholders have different rights. They receive the dividends first and only after the equity shareholders are paid dividends. Usually, preference shares have a fixed rate of dividend. The preference shareholders they don't have any voting rights and they cannot be part of the management and their dividend is fixed. Fine. Now, what is the difference between bonds and debentures? Bond is a debt instrument, and debenture is also a debt instrument. Right? The difference between bond and debenture is that bonds are issued by both government as well as private sector entities, while as debentures are only issued by private sector, that means by corporates only. Number one. Number two, bonds are always backed by collateral security, while as debentures are not backed by collateral security. That's why you will always see that debentures pay more rate of interest than bonds because debentures are riskier as compared to bonds. Whichever instrument is more riskier, you get better rate of interest, but at the same time of at the cost of some risk. Bond holder is called he is the owner of the bond. Owner of the debenture is called a debenture holder. This is the main difference between debenture and bond. So we can remember that bond and debenture are both debt instruments. Debentures are not backed by any collateral security and are relatively at a shorter period, maybe for 3 to 5 years. Bonds can be for a longer period, 15 years, 7 years, 10 years. Debentures are normally of a relatively medium term periods. This is all I had to share you about financial markets. So, I will be discussing about the bonds in my next video. I hope you have understood about the financial market in India. Still, if you have any doubt, please do not hesitate to text at 94191 86088. Please do share this video and like it. Thank you.